All right. Well, hopefully you had a nice break. I got to sit down for a minute, which was nice. So we have rolled right into Module 3, and we'll go Module 3 right into lunch. So I'll try and keep us moving on that so you guys can roll right into that. But this is some good stuff here in Module 3. We're going to talk a little bit about concept selling, LIRP, life insurance retirement plan, single premium whole life, a will for the business, and asset classes. So we got a lot packed into this module to get you guys in before we break for lunch. So, and this, Brian, we might be able to detour into this in the concept with the long-term care a little bit in our conversation, so feel free to chime in at that moment. So with that said, so asset classes, and this is designed to help you provide maybe some framework around a conversation you're having with a potential client if you're talking about asset classes. So asset classes, typically people automatically think of the first thing up here. For whatever reason, we're trained by the financial services industry to think of market instruments when we think of assets. So stocks, bonds, mutual funds, that would be one form of asset class that we talk about. And that's usually what people think of first for whatever reason. There's also real estate, your home, if you own any investment properties. Anything along those lines would be an asset class. Metals, we got some gold bugs out there, some silver, some palladium. That is definitely an asset class. If you've been in it for the last 20 years, you're up 500% in gold, approximately. Bank instruments would be more what I'm talking about there would be cash. CDs, checking, savings, cash accounts, highly liquid would be your bank instruments. And then our friend right down here, life insurance is an asset class. And I hope to make that point clear as you're having conversations with clients who don't know much about life insurance, which is all of them, that they can start thinking of it in terms of an asset in their portfolio. So it's an asset, even if it's term, it's an asset. Universal life, whole life, index universal life, variable universal life, whatever it is, think of it in terms of an asset class, perhaps when positioning that conversation with a client. So asset classes for life insurance, what do you mean by that? Well, is there any other financial product that can do all of the things life insurance can do? Can anybody think of one that does everything that life insurance does? There isn't one. It's a trick question. After-tax dollars, grows tax deferred, comes out tax-free, FIFO. That's the magic of life insurance. There's nothing else that can do it. Now, it can't do everything, but no one else can say it can do all of that. It provides a 100% tax-free death benefit. It's instant liquidity when cash is needed most. Think of Mike and Tracy with 2 young kids. She needed money for time to grieve, and she had it. Protects all of the other financial plans. What do you think I mean by that? How does it protect the other financial plans? Sir?
Because when you die, if you don't have life insurance, you have to use all your other assets to fill in what life insurance would do.
Yep, good point. Yep. Protects the other financial plans because it's self-fulfilling. Is my 529 account going to be full of all the money I need to send my son to Princeton because I died? No. Woefully short. But life insurance is self-fulfilling in the plan in and of itself because the cash is there immediately. So self-fulfilling, protects the other financial goals. Now with the life insurance money, now I can send my son to Princeton even though I'm dead. He can go to Princeton. The exact amount of cash for a business transfer. Is there another asset class or product that can be timely as life insurance in transferring a business at the time you want it transferred? No, there isn't. It's the most efficient way to fund a business plan or business transition plan is with life insurance because it's an exact amount of money based on the valuation of the business that you get when you die. Or it's there to move it from partner A to partner B. And I've got a couple examples I'll work through on that. But this is life insurance as an asset class and all the things that life insurance does. It's singularly unique in the things that it does. It's a great product. It's a great thing to have in part of your financial pyramid. Remember the pyramid? That bottom row, what was in there? On the right-hand side. next to that, life insurance, thank you. Life insurance was on the bottom row of the building the foundation of your pyramid next to the will. Picture in your mind. Maybe I should have added color to that. All right, couple of concepts that we're going to go through in concept selling. And one I like because it's very easy, but it's very effective, is single premium whole life. A single premium, very easy to do. It's great in the estate planning market. One premium payment, it's easy. I pay once, that's all I got to do, and it's on autopilot essentially. It's good to go from there. Shortened underwriting process, that's the net amount at risk. So as an example, if I got a $100,000 death benefit and I put in $50,000, the $50,000 difference between the 50 and 100 is the actual amount that's being underwritten. So it's a shorter underwriting process because they're only insuring or underwriting the net amount at risk. So in other words, we're not underwriting your $50,000 that you're putting into it, just the difference, the 50 to 100. Does that make sense? Okay, so that it's a much faster underwriting process, and you can tell people that too. Say, hey, we're only underwriting the net amount at risk here, so the process is probably going to be a little quicker than normal. So that's an advantage, certainly. It's easy, that's an advantage. And a reallocation of resources to improve the efficiency. And I think Brian was talking a little bit about, he had the client that had cash in the bank. This is a reallocation of resources to improve the efficiency. So money in cash or CDs or bank instruments that's liquid, that's already earmarked for the next generation, that money is for my kids. That's what it's going for. It's cash, it's sitting there, that's what it's gonna do. Let me show you a more efficient way to do that. It's an efficiency move, it's easy, and it already is taking on dollars that are earmarked for the next generation, and you're leveraging that 50,000 as an example to 100,000, so you're able to leave more money. Really, really good, easy sales technique. I think I've got an example. It is underwritten, but it's less of an underwriting challenge because it's only the net amount at risk. So it's a shorter amount of time involved and a lower face. Like so if the face is 100, you're only doing 50. If you put in fact, does that make sense? Yes. Okay, perfect. Question, yes, sir.
Will that cause them back?
Yes, it's a modified endowment at issue. Typically, there's only one company that I've seen that that's a great question. There's one company that I've seen that it is not a MEC, and it's if you 1035 the money in, it doesn't MEC it. It's an anomaly. Otherwise, though, think modified endowment. But that's okay. It says it everywhere. Every page has it in huge bold letters, modified endowment, you can't miss it. But you're moving this money, it's a death benefit anyway. It doesn't change the tax exempt status of the death benefit. It's just if you're pulling money out before that, then it's a problem. But if you're earmarked it for the next gen, it doesn't matter. But yes, it is a modified endowment at issue in almost every single case. So look at a potential market. It's like, that sounds good. Well, who could I use this with? Well, meet Joe. Joe is 65 years old. He's in good health. He's single. We'll fill in the story here. His wife passed away 5 years ago from cancer. He has $100,000 in cash, just like the client we talked about earlier, and CDs at the bank that's already earmarked for the next generation, the grandkids. So Joe knows, hey, I'm putting this aside. I want them to have the money to go to school or whatever it is they want to do, start a business. You're leveraging the $100,000 into a higher death benefit, thereby passing along more money to the grandkids. So you're leveraging that 100 into maybe 150, let's just say. So you're providing more to the grandkids than just giving them the cash, and you're also doing it more efficiently because it creates a tax-free death benefit direct to the kids or in trust for behalf of the kids. However you structure that doesn't matter. It's still tax-free. And there's only one premium payment. It's easy. When you're talking with someone 65 who maybe doesn't want to be drawn into a complicated discussion on estate planning, this is one and done, very easy to get someone through the concept. Very, very easy to talk to. Yeah, money.
assuming their estate is less than 11.6 million, this money would be tax-free anyway, correct?
Correct.
Pass on.
Yeah,
But the biggest advantage is you're levering from 1 to 150 or 200, whatever.
correct. Yep. And if there's any estate changes coming up on the dollar amounts, you're positioned well for that change, but that's a great point. I know they're bandying that about in Congress. You know, who knows how that's going to come out, whatever. But in the interim, this certainly is not a bad strategy regardless of what happens, though. But that's a good point. So this is the market typically. You can use it in other age groups, certainly, but as a way to think of it, like where would I use single premium whole life? This would be a pretty good candidate for that opportunity. Several different carriers utilize single premium chassis. I would just look at it, compare it, see what you like. You know, if there's a company you favor, great, for whatever reason, or maybe there's a long-term care rider that can be attached on there too. That could be important. I don't think it in estate planning per se as much, but it's possible. It'd be something else you could look at. Yeah, money.
What companies are we using right now for Heartland for this?
There's a couple of single premium ones on there. The last one I saw done, Securian was one. Let me think, single premium. Pac Life is not one. Nothing else is jumping to mind. Let me think about that. I'll give you another one in a minute. Securian's top of mind for some reason. I just saw one from them. So as an example, this is the market that we're looking at. And if you need to see a couple of different quotes on, we can certainly do that.
Is there an IUL option for single premium, or is it just whole life?
Good question. You can do index universal life on a single premium. However, I don't recommend it. Typically, in most cases, the chassis on an index universal life is designed for the more the better, the longer the better as far as funding goes. So it's rare, very rare that I see a single premium IUL work. You can do it, but I don't think it's the most effective use of a index universal life chassis. Does that make sense? But you can do it, but it's not optimal.
Because normally each month, you know, it'd be a different index segments, right? The premium would be going to different accounts each month for the IUL.
Right. Right. Yeah. In a normal overfunding scenario on index universal life, which we're going to talk about here, it looks better when the money's constantly coming in as opposed to the single premium. It's just the way the chassis is designed on universal life. It just does better that way. But you can certainly look at it and see if you like it. So this concept talks a little bit about what we were just talking about. Life Insurance Retirement Plan, or LIRP. We love our acronyms in this business. There's no end to them. So LIRP, if you haven't heard of, you now have. Life Insurance Retirement Plan. Client with a death benefit need purchases cash value life insurance. I underscored that, underlined it, and highlighted it because there has to be a need. If you're selling life insurance without a death benefit need, you're not selling life insurance correctly. Death benefit need has to be established first, and then you can start talking about the designs and the bonuses and the additions and the extra cool things that life insurance can do. But if there's no need for death benefit, imagine defending that in front of the state of Missouri insurance commissioner on why you sold life insurance when they didn't need life insurance. Indefensible. You will lose every time. So establish the need, and then you can possibly plug in the LIRP scenario or whatever it is you're trying to accomplish on that. Maybe it's a long-term care rider, all good. But establish the death benefit need first. Client pays maximum premium payments in relation to the death benefit. So on a life insurance retirement plan, we're trying to max fund it. We're trying to put in as much money today as we can and not turn the contract into a modified endowment, because we want to, the tax advantages are gone. If you put too much in and you mech the contract, you've killed the concept. So the maximum you can put in without making it a modified endowment, and you'll know, you'll look at it when you run the illustration, you can see what the numbers are. It's not a mystery to figure it out. If you go over it, it'll say it in 50 different places on there that this is a modified endowment. Yeah, money.
Hey, Matt brought up a good point. We got some newer people in here.
Okay.
Who may not fully understand what the MEC is.
Okay.
Could you maybe talk about that?
Absolutely. Great question. I apologize for not being a little more thorough in that. Modified endowment contract is essentially, it removes the tax favored status of life insurance. So when you have a index universal life, for example, and you take money out of it, it is not a taxable event if you did it for income. If you have a modified endowment contract and you take money out of it, it is a taxable event. So what happens if you put too much money, and these are IRS guidelines, if you put too much money into the contract, it forces up more than the death benefit can handle, and it flips it into a modified endowment contract, which still is a life insurance contract, still provides a tax-free death benefit, but it removes the tax-favored status of withdrawing money out. Does that make sense? Very important. Typically, you don't want it to be a modified endowment. In this scenario, you never want it to be a modified endowment. In the previous example, the single premium whole life, that is a modified endowment. That's okay because it's just a death benefit. That's all it's doing. You're paying a death benefit, it's still tax-free, but you're not pulling money out of it. Once you pull money out of it, if it's a modified endowment, you got a tax bill.
Now, I mean, for kids, you know, wouldn't that be, you know, a bad thing? I mean, this is talking about a kid having.
So a juvenile sale?
Right.
Okay. What's the purpose of the sale? I would ask you that. What are we selling it to this child for? College funding, or we're just locking in good insurability, that sort of thing. I would ask what it's going to do. If it's to take money out for college, no MEC. You don't want it MEC'd, because then you're just going to hit a taxable event every time you take money out. Uncool. Newer people on modified endowment, can you pass the test? If I gave you a test on MEC? If you can't, then I didn't do my job. Everybody comfortable with MEC? What that means? It can be okay. In LIRP, it's bad.
So if they do pull money out of it, they're taxed on just whatever they pull out of it, or?
First in, it loses the FIFO, or first in, first out status, which is tax favored, and becomes last in, first out, like an annuity, so it's taxable. So the benefits of life insurance: replace the lost income due to premature death, grows tax deferred, that's the magic, may provide tax-free income in retirement. So if we fund this properly, and we'll just use for an example, index universal life, if we're max funding it, remember this right here, maximum that you can put in, we ultimately want to take that back out tax-free. So it's grown after-tax dollars, grows tax deferred, comes out tax-free. Does that sound like anything else you guys sell? Any other concept come to mind? There's one. There's one. Roth. After-tax dollars, grows tax deferred, comes out tax-free. This is a super Roth in that regard, and it has a tax-free death benefit. So if you come across a client who has a Roth, and you ask them, why did you open up a Roth? They'll say, I don't know, my cousin Mike told me to do it. Or they'll say it's after-tax dollars, grows tax deferred, comes out tax-free. If they know what they're talking about, they wanted tax-free income, that's why they're doing a Roth. That's why you would do a LIRP. You have the ability to tap that asset, because it's an asset, in retirement to offset or stand alone on an income stream that is not taxable.
So is LIRP equal to a Roth? I mean, as far as, if you wrote someone a LIRP and they have a Roth, would it justify, putting them in a LIRP over a Roth?
Go back to that. If there's a need for death benefit, then you're going into a LIRP. The Roth can be a really good tool, except it is capped, right? It's capped on how much you can put in, and there are income requirements on there to phase you out of a Roth. Not so with a LIRP. Yeah. Yep, so that would be the kind of differentiator, but always in the life insurance conversation, always death benefit need, then you're in the right direction.
Maybe talk a little bit about the prospect for this, unless you've already got it going, unless you've already got a slide for it later on.
I do.
You already do? Okay.
I do. You're thinking with me on this one, my man. Thank you. So more on LERP, and I'm getting to an example on that, Brian, thank you. IRC, Internal Revenue Code, section 7702, sounds complicated, sounds scary, IRS. All that is where life insurance is defined in the Internal Revenue Code. So if you looked up section 7702 after this class immediately on Google, you would find life insurance. And the reason that's relevant and why am I telling you that, I knew a couple of agencies that didn't sell life insurance, they sold 7702 plans. And it worked. But they were telling them it was life insurance, which they better, but they were positioning it as tax advantage under section 7702 in the IRC code. Cool, another way of thinking about it. Not right or wrong, just another way to look at it, but that's all it is. It's the code where life insurance is defined. It's where you find the language on modified endowment and tax deferred status. Another term I'd like to introduce you to is retirement income engineering. Remember, you're educators, so you can educate a person on what the heck does that even mean. Well, I'm happy to tell you. Retirement income engineering is engineering the best possible outcome in your retirement with whatever tools we can do that with. And life insurance is one of those tools that can provide a tax-free income stream, along with a Roth if they had one. That's tax-free income stream too. Is a 401k taxed in retirement? Yes, it is. 403b? Yes. Everything else? Yes. Yes, everything else is taxed. There's only a couple ways to get tax-free income, and the LERP strategy is one of those, and a Roth IRA is another. But you're engineering the best possible outcome for the client by possibly having tax-free income running alongside taxable income. So they've got $500,000 in a 401k plan. Great, you've saved a lot of money, nothing wrong with that, all good. It's now time to generate income from that. That asset is now going to pay you. That's the idea in retirement, but it's taxable. So that's ordinary income as it comes out. It's not a bad thing that you've got $500,000 in a tax-deferred vehicle. That's okay, but just know you're getting taxed on it as you generate the income on it. In the LERP strategy, you're not getting taxed. So you're pulling that money out. It can run alongside whatever plans you already have in place. You're engineering a more positive outcome in retirement. If you ask a client this question, they can answer it one of three ways. And let's see how you guys answer it. When you retire, what are taxes going to do? Go up, go down, or stay the same? What do you guys think? How many ups? Oh, really? I'm so surprised. How many downs? Okay. How many stays the same? Okay. It doesn't matter what they say, because this prepares them for whatever scenario they answer. You don't have to be a tax expert, but you can talk about the tax advantages of tax-free income. Taxes can go up, they can go sky high, and you're still generating tax-free income on this asset. You don't care. I mean, you care, but you don't care as much. But you care on that 401k asset when the taxes have gone up. That's a problem now. That's a big problem. So this can run alongside anything you've already got going on, and there's no time when you have to take the money out. It's not required by section 7702. So if you wanted to wait until 75 to start generating income off this, you can do that. If you want to start it at 62, you can do that too. And you can stop it anytime you want. It's not like that 401k money that you have to take it at what age? Right. Yeah, you have to do it. Or otherwise you get tremendous penalties. It's so not cool the way they do that, but it is the reality of the IRS. So the LERP strategy, very powerful, and we're going to go through an example of who is a candidate for LERP. That's a good question. Thank you, Mr. Askins, for setting that one up. We didn't plan that. The LERP market. I put this on the top again because it's something I don't want you to ever forget. There has to be a need for a death benefit, always. Okay? Once you establish the need, you go from there. You're good to go. Look for someone who has a saver's mentality. Clients who demonstrate a saver's mentality. What the heck does that mean? Well, do they have any savings plans in place already? Are they putting money aside already? Are they saving for college? Are they saving for retirement? They've got a checking account for their dog. I've seen that. Savings account, not a checking account. The dog couldn't hold the pen. But it is a saver's mentality nonetheless. You're looking for that, and there's ways of ferreting that out, just as I've explained. Clients who have maxed out other savings plans, so they're at work, they work for a company XYZ, and they've got a great 401k plan, they match 6%. It's dynamite. They've got 30 different options that they can allocate to, but they're maxed out. So they can't put any more dollars into it. They're probably done with it, let's say, early in the year. What else are they going to do? What else can they do? Well, they can look at a LERP. That's where those other dollars can go. Clients with concerns related to taxes during retirement. We just talked about that. Is anybody worried about taxes that you talk to? Nobody?
Everybody.
Everybody. Yes. Everybody's got it on their mind in some way, certainly. So tax savvy clients looking for ways to engineer a tax efficiency is a potential client for a LERP.
When the salsa alert, you wouldn't have the risk of the loss of your 401ks either.
I'm sorry, say that again.
You wouldn't have the risk of loss as 401ks have with the stock market is if the stock market falls apart, your 401k losing money.
Okay, and that's a good point. Yeah, it can, that certainly can be a more risk positioned asset depending on what that 401k is allocated in. It could be in a cash position in the 401k, earning, 0.0001 or whatever it's earning, but it would still not be susceptible to market correction. But if you're in a, high cap growth fund and the market tanks, you're going with it. You're going right down on that ride, and it's not a pleasant one. But in the life insurance, yes, there's some protection there. It's called a floor. So you don't write it down typically for that reason, but that's a good point. So knowing what their allocations are within that 401k, 403b, whatever, would be very important. And also when you're going back to risk tolerance too and talking about that, good place for that. Yes, sir.
What kind of contribution ideal target? I understand it's going to be different with, like, say, a young professional that's maxing out a 401k and a Roth, so that'd be approximately $26,500 that they're already putting back for retirement. Obviously, $1,000 into alert might not be as lucrative. So, like, would you say, like, would it be $5,000 commitment? Because then I also know you get a middle-aged business owner that can dump in a custom 10-pay into $25,000 or $100,000 a year in a custom 10-pay. What's kind of that balance that you say for a young professional, that's putting back money to where you see that being very beneficial?
Yep.
Would it be like 5,000, 10,000? I know it's going to depend on
Yeah.
the client and the situation, but
That's a great question, and there's no one answer for that. I would bring you back to this. If you're starting there, that's your starting point always, whether it's a business client or a young professional or whatever, and establishing that need, and then you can determine the funding on it. And then you've got, let's say it's a $1 million need, maximize it to the absolute most you can get in there if they can afford it. That's where I would say the answer lies. Cool with that? Okay, good question though, because and I get that a lot. Is there one it depends. Unfortunately, it's one of those answers. It's like when you try and get a straight answer from the IRS. It depends. So,
One other thing too, I think
yes.
this is a really easy product to sell, and everybody has a great market for it because it's anybody that's self-employed, anybody who has to provide their own retirement. All of you in this room, you're self-employed, and or the majority of you in this room are self-employed. You got to provide your own retirement so you can be your own best customer again.
Yep.
Another one is, just like was already been mentioned, the highly compensated individual, to where, like, if you've got a person making $30,000 or $40,000 a year and they're putting in 10% into their 401k, that's different than a person making $300,000 to $500,000 a year putting in 10%. The person that's making $30,000 to $50,000 may not be maxing out that 401k, but the person making $300,000 to $500,000 is by far maxing it out. They're maxing it out in, April or May or June.
Yeah.
And to where they're protecting a much smaller percentage of their income on the 401k. And so the highly compensated individuals, the self-employed individuals, there's great prospects for this product, and these are tremendously great products.
Yep, absolutely.
Tremendously great.
Great expanding of the market on this too. Yeah, Monty?
I think to add to that, maybe when you get a little more advanced, is you're having a conversation around their 401ks.
Mhm.
If their company's only giving them 3%, well, they don't need to be putting 12% of their own money in there. Our strategy is you match whatever your company gives you. Because if you don't, you're putting your money in jail. You can't touch it hardly for any reason.
In the 401k.
In the 401k.
Got it.
Well,
Okay.
If they're giving you 3%, you put the 3, and if you got more to save, then you put it in the IUL.
Okay, and that brings me to a good point. And I'm so glad you brought this up, as I didn't have it in my notes. But would you ever counsel someone, think carefully about this question, would you ever counsel someone not to do a 401k if they were getting free money and go into a LERP? No. The answer is no, never. Never turn.
Take the free money.
That's right. Always take that free money because it's the only place you're ever going to get it, is in that scenario. So if you're building a LERP and they have a 401k and like Monty said, as far as the percentages and all that, you can do both certainly and have it run alongside it. But never counsel someone to say, I'm not going to put it in the 401k. I'm going to pass up that 3, 4, 5% free money and put it all into a, no. Get the free money. At the very least, get the 3, 4% or whatever the match is at the minimum, and then consider this.
Would you counsel them to at least match what their company's giving them and then look it up?
Yes, that's my point. That is exactly my point. At least, at the very least, get the match, get the free money, and then you can look at other opportunities. Yeah, Israel.
I want to make sure I'm understanding correctly.
Yes.
So the LERP and the IUL, are they synonymous or are they different in the sense of, with the IUL, death benefit really isn't the key?
Good clarification. I'll make this very simple, and I thank you for asking that. LERP is not a product, it's a concept.
Okay.
IUL is a product. So yeah, so think once you separate that in your brain, it should crystallize. Yeah, so, and I'm using IUL as the primary example because that's really what most of these are. A LERP is normally Index Universal Life.
Okay.
It could be variable as well. You could be overfunding a variable contract. But LERP is the concept, IUL is the product. And then the other component we're looking for, we talked about taxes, is can they afford it? Is this gonna work? If they can't afford it, the funding, don't do it. Don't do it. If you're trying to go minimally funded when you're running the illustration, you're already in trouble. Okay, you want to max fund it, is where you want to be on this, or at least target as a minimum, but never that minimum. You get that choice when you're running illustrations. Oh yeah, I want to minimally fund it. No, do something else. Do not minimally fund it because it's not going to work. It's just not. Oh, we're going to make more money great, we'll come back to it in 5 years. It's just not a minimally funded concept. It's a maximum funded. The more money, the better, the longer the better is a LERP in its ideal scenario. Keep forgetting I got a clicker up here, Matt. You gave me this clicker and I'm not even using it. There, it works. Okay.
That's not spelling, so.
Scotty, I'll fight you outside.
I'm going to shift the conversation just a little bit. We're doing concepts, so this is another concept. So we talked about single premium, we talked about LERP, and the other is business market. Is anybody actively working in the business market, whether it's small, mid, large, any form of business market? 4 people? Okay. Good. I'm glad there's some people working in it. This is a very lucrative market. It offers you tremendous opportunities. If you're not in it, I would suggest looking into it and seeing how you can penetrate this because the sales are typically much larger when you're in regards to life insurance and a lot more opportunities because you can insure the business and you can insure the individuals and there's a lot of different things going on in there that you can work on. And I would say don't ever be afraid of it because it's a business market. When I was a young agent coming into it, I was more intimidated with the business market because I was sitting down with these business owners and I thought they know everything. And I don't know anything about their business. And it was intimidating. And once I got over that, I realized that they don't know anything outside of their business. That's what they're an expert in, and they're dynamite at it. and they're running 24/7 on that business and they're making money and they're incredibly successful, but that doesn't mean they know anything about financial planning at all, and most of them do not. 7 out of 10 have no plan in place for succession. 7 out of 10. If you go into 10 businesses in the month of February and have a meeting, 7 of them have nothing in place to move the business to the next generation. Nothing. Opportunity abounds big time in the business market. That's why I got this in as a concept. Does your client have a will? That's a question I always like to ask. Does the business have a will? Does your business have a will? I don't know. What do you mean? There's a conversation right there. The will is the succession of the business. Do you have a plan in place to move the business from you to your kids or you to the key person or whoever it is? Is there a will in place for the business? Good conversation starter. Should I separate the business fact finder with my business clients, or should I use a separate fact finder? I've got a couple examples on that, and I'll start this around. You guys can kind of pass it around. I only had time to print a few, so check it out. I would say yes to that. If you have a business client and you're going in on a business conversation, a business fact finder specific to that is probably a good idea. There's a bunch of really good examples out there. The one I got here is from Advanced Markets Online. It's pretty good. Also on, I know top of mind, Pacific Life, Securian, and Principal all have business websites that are microsites that have fact finders on them. And you can go in there and print it out and use it. And there's a bunch of other really cool tools, like talking about the business valuation, the concepts. If anybody wants those sites, I can email that out, or Brian, I can send it to you and you can forward it to the team. Really, really good tools, really good business fact finders. It gives you a track to run on again, and it gets you talking specifically about the business. So I would say yes to that question. I would use a business fact finder to make sure you're not missing any sales in the business side of that conversation. I always ask this: how is your business structure? How do you pay taxes? Are you a pass-through entity? Are you a partnership? Are you a sole proprietor? LLC? That's going to tell you a lot. So if you don't remember any questions to ask that one at the very least. How is your business structured to pay taxes? Do you have a succession plan in place now? 7 out of 10 surveyed said no. So you probably will get a no on that one, and that's okay as a closed-ended question because you know a lot right there. If they do have one, can you see it? Can I take a look at that? What you're looking for in that is to see if it's funded with anything, primarily life insurance, and when it's dated. How is it funded? Has the business grown since you originally put it in place? I came across a business owner years ago, very successful guy. He was a sole proprietor. The business was worth, he had 2 or 3 million in revenue. I can't remember exactly now. Very good. A couple people working for him, very solid business. It had grown big time since he had gotten into it. He had a business plan written like 20 years ago that was for like 1/10 of the value of what the business was worth today. And it was dated, from the 80s or wherever. Oh, I couldn't believe it. And I'm looking at this, I'm like, we need to update this. We need to get this up into the current valuation of the business. Is your business worth more than it was in 1987? Yeah, you're doing pretty good. We updated the plan. So if you can see it, when was it written? And if it is funded, what does that mean? Is there anything that puts money in place immediately to move the business to someone else? And the most efficient way to do that is through, any thoughts? Life insurance, absolutely. There's a couple other ways they can do it. They can have a sinking fund. They can have, cash, blah, blah, blah. They never work. Life insurance goes based on the valuation of the business. It gives you the exact amount of money, the exact day and time you need it. The sinking fund, you might have just started it this year and you need $10 million in it and you got $53.86. It's a little short. The life insurance matches the valuation today. That's the most efficient and effective way to fund the plan. And you want to find out if it's funded. If they've got it funded, how are you funding the plan? We have a life insurance contract with XYZ company. Great, can I check it out? Mind if I take a look at it? This is part of what I do. I offer reviews on existing plans and make sure it still matches the goals and objectives you had when you originally wrote it. And check it out, see what it's got. But those will be the things within the business market that you're looking for, that you're asking, that you want to talk about and bring up of mind. One of the fact finders, and I think that's the one circulating now. This is hard to read, I apologize for that. But this is Nationwide's fact finder. And it's got different questions on it about the succession, the generalities of the business, stuff that you need to ask that you might not always remember when you're in with a business client. So a business fact finder, again, powerful tool. I would add Nationwide to the list of the other companies I mentioned that have a microsite and a business fact finder specific towards business clients. So good tools, check them out, see what you like, use one of them, but at least use something. Have that one in your briefcase ready to go when you run into that business owner client, which sometimes you do and you didn't know it. You got that one, go right to that business fact finder. Just have that thing ready to go. You will use it sooner or later.
Does First Heartland help with that quality also design on businesses?
Yes,
Okay.
yeah, absolutely. In fact, there are 2 carriers that I can think of that will offer up a valuation on the business itself. So if you went to, I think it's Principal, what's that? Principal. They still do it, although they've changed a lot lately. Securian does it, Principal, and there's one more. It's not PAC. Prudential, do they do it? Okay, I'm not familiar with that one. That's a good one too. But what they'll do, what that means is if you bring all the information to them, they can provide you a valuation of what the business is worth, ergo how much life insurance would be needed in that succession planning. So there's tools available to you. You don't have to know how to do that. Use the people. You can go through First Heartland for sure. You can go to a carrier direct. Brian's a great resource for this too. And taking it in the right direction. So lots of tools out there to get the business valuation so you can get the appropriate coverage amount nailed, because that's really, really important. If you come up short on that, it's ugly. I've seen it, it's disastrously bad. So let's look at an example that you guys might run into. A partnership, I think, is common, very common. I ran into it all the time. Most of the time, that's what I ran into. So let's look at Jack and Mike. They are 50-50 business partners in an auto enhancement company. We'll call it Mustangs Unlimited. The horsepower they create is unlimited. Just the marketing. They have been in business for 10 years. They have $2 million annual revenue. So they're doing some business. Both Jack and Mike are married with kids. So this is kind of the great American story here. Both in business together, partners, bless you, and doing well, have a nice family. One morning, Mike wakes up dead from a massive heart attack. Yeah, right? Not a good morning, not a good way to start your day. I do not recommend it. So Mike has passed away unexpectedly. What now? Asks everyone. Well, Jack, he's still alive. He's now in business with Mike's spouse. 35 years of asking business owners the question, do you want to be in business with your partner or spouse? The overwhelming answer is no. And it's not because they don't like them. They like them, but they may have nothing to do with the business at all. Absolutely nothing or no interest in running Mustangs Unlimited, for crying out loud. And it's a great business. I mean, what's wrong with making Mustangs faster? So that's the outcome without planning on it. Is that what Jack and Mike wanted for the business? My guess would be no, absolutely not. They had bigger things in mind, like maybe the kids taking it over one day or whatever it was, but it wasn't to go in business with the spouse who is grief-stricken right now because they just lost their spouse, and now they're gonna run a business that they don't know anything about. Not a good prescription for success. Is that what Mike's grief-stricken spouse wants? Probably not, in most cases, no. What could simple planning have done to prevent that? What are your thoughts on that? 2 partners, what do you think? Buy sell. Tell me a little bit about that thought.
Buy sell agreement. When Mike dies, his life insurance buys his half of the business to Jack.
Correct.
And
Excellent.
Jack has that extra money to take some time to either hire somebody to fill Mike's position has that time to maybe even like float the business for a year or two, because now Mike is gone.
Excellent. You might have been looking at my slides. Well said. That is exactly it. You nailed it. So this is a business partnership cross-purchase plan. And this is like, again, the reason I put this on here is because as an agent, what did I run into most? This. This is the scenario in business that I ran into most frequently. Sole proprietor, business partners, 2 people. The structure is just exactly how Tony described it. So you have A and B. Mike and Jack, let's make them people, or Jacqueline. Mike and Jacqueline, this looks like she's got a dress on there. They execute a buy-sell agreement, which they agree to buy and commit their estates to sell. Is this a legally binding document?
Yes.
Survey says, how many say yes? How many say no, you have to vote? You have to vote, yes or no? Yes, it's a legally binding document? Camille? Okay. Over here, you're too quiet. Legally binding document? Yes. The yeses win. It is a legally binding document. You have to go through with what the intention of the contract, because it is a contract, so you have to follow through with it. Who should write this document? An attorney. Should you write it ever? No. Unless you're, thank you. Unless you got JD after your name. No. It's not that it's complex. In most cases, you can look at a buy-sell in a partnership agreement, it's 4 or 5 pages. It's nothing really in there that you wouldn't understand if you read it. Get it done by an attorney. Definitely has to be written by an attorney. And if that attorney's in your network, that's cool because you can still refer business back and forth to each other. All good. Get the attorney to write it. Varying amounts of money could be spent on that, anywhere from, $1,000 to $10,000. I don't know. Every attorney's got their number. No logic there. It just depends what you get. So as Tony was talking about, you've got B buys insurance on A buys on B. They're not married or related. Can I do that?
Yeah, they have
Yes.
financial
Why?
responsibility.
The business relationship.
That's the word I was looking for, or words. There's an insurable interest that exists between A and B. We're in business together. We've drafted this document. I have an insurable interest in A is in me, because the business won't run without one of us, or it's going to have severe financial impact. So there's an insurable interest that exists. I buy it on you, you buy it on me. If you die, the money goes to me, and it guarantees to go to the estate to buy out the dead person's portion of the business. You've done a proper valuation on the business. You know it's worth $1 million. You have a $500,000 life insurance policy on each of you, so you buy that half of the business. Insurable interest exists. A buys B, B buys A. When you die, the life insurance company pays the beneficiary, which is A or B, depending on who dies. In my examples, you don't want to be one of my examples because you usually end up dying in my examples. So I guess calling them A and B is good because then it's not really anybody. That is the simple form of a cross purchase. I think that's what you're going to run into most. For whatever reason, when I was a young agent, I found this to be intimidating, and I don't find it intimidating anymore, and I don't want you to find it intimidating either as you have conversations with business owners. Most of the time, this is right around the world you're going to be in most cases. Right.
One big thing is anytime you're in front of a business owner, always ask them if there's 2 partners. Always ask them, is there a buy-sell? Most of the time, they're going to have something. Not all the time, but something. But also, go ahead and build some type of relationship with a business attorney, because you're going to refer a lot of business to those individuals, because if you get out there, you're going to come across a lot of business owners. And go ahead and build that relationship where you can refer that person to that business attorney, and that business attorney, chances are, is going to start referring you a lot of business. But go ahead and, if you don't have one in your network already, get the yellow pages, call a couple, go to lunch. I promise you, it'll turn into be a nice thing. And once you get these, once you do, sell some life insurance and buy sales, and I'll give you a perfect example. There's 3 business partners. They just brought on a 4th business partner. So they called me to insure that 4th business partner. This just happened 2 weeks ago. And so what I was doing, I said, well, let me ask you a question. I said, how's your business done over, because it's been, you know, a little 2 years, almost 3 years since we've done the other two. And I said, has your business grown? They said, yes, it's grown drastically. And I said, what's your business valued at now? And so they tell me the number, and I'm like, the $1 million worth of protection we have is not enough.
Yeah.
And they said, well, we actually thought about that. And I said, what number are you thinking? And they said, what if we all went to 2 million? And this just happened. And so went to 2 million each for now the 4 business partners. So get in there and review those every couple of years.
Yep.
Because that business, if it's successful, and most businesses are, a lot of businesses are, they're going to grow. And that $1 million turns into 2 million in a couple of years. I guarantee you this is going to be a $3 or $4 million per person business, because this business is growing drastically.
You bet. Great
So
point.
build those relationships.
Yep, great point on that for several reasons. The relationships, building the networking. If you get an attorney or a CPA in your universe, that's positive. And annually, at least checking in on that business on a insurance review, on that annual review, and seeing exactly what Brian was describing there. Well, where are you at in the business? Looks like you guys had a great year. You're probably worth twice as much now. And then there's some work for you there to update that and make sure it's current. Yes.
Isn't there something along the lines with this that they don't only carry insurance like on A and B, but to take over the part of their business, they take there's an insurance to make up for the income that they would have brought in? I haven't read that someplace.
It could be another concept outside of this. I think I know what you're talking about, but as
Like
far
if you passed away, you would bring the business in some kind of income
that's factored into the valuation. So the valuation should be factoring that in to account for that and everything else. Yeah, that's a great point. I think that just worth clarifying on that. So buy-sell entity is the same concept that we just talked about in the cross-purchase, but you've got more than 2 people. So whenever you start getting in a business that has more than 2, excess of 3 typically, you're gonna probably shift to an entity purchase, which is the business owns the life insurance, not you and me on each other. The business then only has to buy, let's say in this case, XYZ company buys 3 policies and owns them on each of the 3 business partners, as opposed to a cross purchase where we would have to buy a total of 6, right? Because I have to buy 2 on each of the other partners, they have to buy 2, and the other guy has to buy 2. Yeah, so you're looking at 6 policies versus 3 if the company owns it. So you're getting into the economics of value on that. And that's where, when you get more people, entity purchase comes into play. It works the same, except it just pays the business when one of the partners dies. Instead of it going to me, it would go to Mustangs Unlimited. Yeah.
Kind of in the concept of this, you go into the key, like a key person retirement. How would, like I said, if you lost a key person in your business and he was responsible for a lot of, and you would lose money for that person gone trying to replace them. Is that kind of maybe more what she was trying to?
It could be, yeah. It's a different concept. It denotes a company that recognizes a particular individual as paramount to the success of the business. Okay, this might have been where you were going. Okay, I'll take it there real quick. So Mustangs Unlimited identifies not Jack and Mike, but the sales manager who brings in $1 million worth of business every year as key to the business. So the business, Mustangs Unlimited, is going to insure Sally, we'll call her, because she brings in $1 million worth of business. Sally passes away, unfortunately. They found her in the trunk of a car with 3 gunshots in the back of the head, and they call it a suicide, but that's another story. So Sally is dead. The money now goes to Mustangs Unlimited, so Mustangs Unlimited can buy time or put the money into getting a new employee, a new Sally, even though we can't replace her because she was awesome, but she's dead now. So that's the key person value. So that gives Mustangs Unlimited, they valued her contribution to the company at $500,000, no, $250,000, let's say, in this context. They would get that money. That gives them time to hire, get a new employee, get a new Sally, or the best they can find for her. That's key person. That's a little different than this, but it's the concept I think you were going for. Does that answer your question?
But it wouldn't be this product that you would want.
It could be any product. This is a different concept, though.
Okay.
Yeah, this is ownership and succession. That is we don't want the business to be hurt. Yeah, the business is hurt by losing Sally. This is Mike or Jack is dead. We need to pay off the estate, and we have one owner now.
I would also assume, you know, as you're doing more buy sell, you know, the value of cases you're doing, you know, increases.
Absolutely.
You know, more.
Yeah.
You know.
You'll deal with large life cases, much larger life cases historically in the business market than not in the business market, because there's a lot more value typically in the business. We're right up on the hour, and Matt's going to shoot me if I go over. So we will break for lunch.